Ever wondered how you can own a fraction of a Picasso painting or a piece of prime real estate in Manhattan? The answer lies in tokenizing real-world assets. The concept of tokenizing real-world assets is stirring up quite a storm in the finance world. These assets, anything from a classic car to a high-end condominium, are represented as tokens on the blockchain, creating a new frontier for investment opportunities. It's not just finance enthusiasts who are intrigued. Major banks, investment firms, and even the art world are taking notice of this innovative approach. The reason? Tokenization is set to revolutionize the finance industry by democratizing access to high-value assets, allowing for fractional ownership and enabling round-the-clock trading. This could be a game changer, breaking down barriers and opening up new avenues for investors worldwide. By the end of this video, you will understand the process of tokenizing real-world assets and how it can potentially transform the way we invest. Before we dive into tokenization, it is crucial to first understand real-world assets. Real-world assets, or RWAs, are tangible or intangible objects of value. These can range from physical properties like real estate, art, and commodities, to financial assets such as stocks, bonds, and even patents. Historically, these assets have played a significant role in investment portfolios, providing a tangible way to store and grow wealth. However, traditional investment in these assets comes with its own set of challenges. For instance, investing in real estate or art often requires a significant amount of capital, creating a high entry barrier for most individuals. Additionally, these assets are typically illiquid, meaning they cannot be easily sold or converted into cash without a substantial loss in value. This can create a lock-in effect, where investors are unable to move their money when they need to. Further, there's the issue of fractional ownership. Let's say you've got your eye on a beautiful Picasso painting, but it's priced at several $1,000,000. Unless you've got a hefty bank balance, you're out of luck. But what if you could own a fraction of that painting, similar to how you can own a portion of a company through buying shares? This is where tokenization comes into play. By converting these real-world assets into digital tokens on a blockchain, we can address these limitations. Tokenization has the potential to democratize access to these assets, lower entry barriers, and increase liquidity. This means that a broader range of investors could potentially benefit from the value these assets provide, without the need for significant upfront capital. But how exactly does this work? Stay tuned to find out in the next scene. Tokenizing these assets could address these limitations, making them accessible to a broader range of investors. Now, let's delve into the process of tokenizing real-world assets. Imagine you have a piece of real estate, a beautiful beachfront property. You've decided to tokenize it to make it more accessible to a wider range of investors. How do you go about this? The first step in the tokenization process is selecting the asset. You've chosen your beachfront property, but it could be anything: a classic car, a masterpiece painting, a diamond, or even a patent for an invention. Essentially, any real-world asset that holds value can be tokenized. Next, you need to assess the value of your asset. This might involve getting a professional appraisal, researching market prices, or using some other method to determine a fair value. For our beachfront property, we might consider its location, size, condition, and the current real estate market. Once you have a clear understanding of your asset's value, it's time to create a digital token representing a portion of that value. This is where things get a bit technical. To create a token, you'll need to use a blockchain platform. There are many available, but let's say we choose Ethereum for its robust smart contract capabilities. Creating a token involves writing a smart contract. This is a self-executing contract with the terms of the agreement directly written into lines of code. The code and the agreements contained therein exist across a distributed, decentralized blockchain network. The smart contract defines the rules of the token, like how many will exist and how they can be transferred. For our beachfront property, we might decide to create 1 million tokens, each representing an equal share of the property's value. This fractionalization is one of the key benefits of tokenization. It allows investors to buy a portion of an asset that they might not be able to afford otherwise. Once the smart contract is written, the tokens can be minted. This is the process of creating the tokens within the blockchain. Each token is unique and holds information about the asset it represents, in this case, a share of the beachfront property. Finally, the tokens are issued on the blockchain. This means they're made publicly available for anyone to buy, sell, or trade. They might be listed on a digital asset exchange, where they can be traded just like any other cryptocurrency, or they could be sold directly to investors. The entire process, from selecting the asset to issuing the tokens, is secured and transparent thanks to the power of blockchain technology. Each step is recorded on the blockchain, providing a clear, immutable record that can be audited at any time. Once the tokens are issued, they can be bought, sold, or traded on a digital asset exchange, just like any other cryptocurrency. This means that anyone, anywhere in the world, can invest in your beachfront property or any other tokenized asset, opening up a world of possibilities for both investors and asset holders. Now that we understand the process, why should we care about tokenizing real-world assets? Great question, and the answer lies in the multitude of benefits tokenization brings to the table. First up, increased liquidity. Tokenization allows for the fluid trading of assets that would otherwise be considered illiquid. Take real estate, for instance. By tokenizing a property, owners can sell portions of their asset, making it possible for investors to buy and sell their shares easily. This was highlighted in a recent Forbes article, which discussed how tokenization is revolutionizing real estate investing by offering alternative fundraising channels. Next, we have fractional ownership. Tokenization enables the division of assets into smaller, tradable units or tokens. Imagine owning a small part of a Picasso painting or a high-value commercial property. By breaking down assets into smaller units, tokenization democratizes investment, allowing more people to participate in the market. Now, let's talk about round-the-clock trading capabilities. Unlike traditional markets, which operate within specific hours, tokenized assets can be traded 24/7. This means investors across different time zones can engage in transactions whenever they want, increasing market activity and potentially boosting asset value. Moreover, tokenization reduces barriers to entry and makes transactions more transparent. With the use of blockchain technology, all transactions are recorded on a public ledger, enhancing transparency and trust. Lastly, tokenization is not just a trend, it's being embraced by major players in the finance industry. A Business Insider report highlighted how investment firms and major banks, like JP Morgan, are issuing more government securities on the blockchain due to the attractive yield on US Treasuries. These benefits could potentially revolutionize the finance industry, making it more accessible and efficient. In essence, tokenization is paving the way towards a more democratized, efficient, and inclusive financial ecosystem. So it's not just about why we should care about tokenizing real-world assets, but how we can make the most of this pioneering technology. Tokenizing real-world assets is not just a buzzword, it's the future of finance. As we look to the horizon, the prospects are nothing short of astonishing. Experts predict a significant increase in the value of on-chain real-world assets. From the current value standing at over $100 billion, it's anticipated to skyrocket to a staggering $16 trillion by the year 2030. Blockchain technology plays a pivotal role in enabling this monumental shift. It's not just about digitizing assets, it's about transforming how we perceive and interact with them. Blockchain brings unprecedented liquidity, transparency, and efficiency to the table. It allows for fractionalization of assets, making them accessible to a broader range of investors. It also enables 24-hour trading, breaking free from the traditional 9-to-5 market hours. Major financial institutions and investment firms are already on board. They're not just dipping their toes in the water, they're diving headfirst into the world of tokenization. But it's not just about the big players. This technology democratizes finance, breaking down barriers and creating opportunities for all. However, it's essential to remember that this is a journey, not a sprint. The market is still fragmented, and there are obstacles to overcome, but the potential is undeniable. The establishment of a national securities exchange could be a game changer, propelling the tokenization of real-world assets to new heights. As technology advances, the process of tokenizing real-world assets will become more streamlined, paving the way for a new era in finance.